welcome to Money Talks, a show that has a very simple goal, and that's to make you richer. I'm Peter Switzer, and on the show tonight we see how Julia Lee uses reporting season to give herself an investment edge, and later Pengarden's Steve Glass will give us his best overseas stock picks. But first, let's just see how Aiken Investment Management's Charlie Aiken plans to invest in 2019. It was a tough year for fund managers exposed to Chinese stocks, but has the tide turned? Charlie Aiken invests here and abroad, so let's just see where he's going to be putting his clients' money this year, mate. How are you?
I'm well, Peter. Well, nice to turn the page to the new year anyway.
Yes, exactly right. And well, we should start where I mentioned in the intro there. It was a tough year investing in Asia, and some of the greatest companies of the modern era, like the Tencents and whatever.
Yeah, no, it was very tough. Obviously, monetary policy was going against Asia, trade war going against Asia, and capital flows going against Asia. So anyone who has an Asian bias like me, because I think there's value and growth there, had a tough year. But as we start 2019, a lot of that's reversed, actually. Asia's leading the world at the moment, the equity indices, and there does seem to be a little bit of emerging market rotation on after the Federal Reserve paused on its interest rate hike cycle. So look, it's been quite V-shaped. December did that, January did that, and here we are. So look,
so a lot of the companies you talked about last year, early in the year, are they starting to make ground from where they were at their worst, probably around?
Absolutely. They bottomed in October, actually. Yeah. Emerging markets in China basically bottomed in
So
October.
when the US stock market was tanking in October, they started to become good.
I think because a lot of the world is underweight or short China and very, very overweight US equities. So when US equities started tanking, long-short funds covered some of their shorts, which are in Asia. But look, that relationship actually bottomed in October, the outperformance of developed markets versus emerging markets. China's thrown in as an emerging market, so even companies like Tencent, Alibaba, Ping An, these enormous companies are considered emerging market stocks. So they've started the year pretty well. So I'm not saying that necessarily the worst of everything is behind us, but it's been a reasonable start to the year.
Okay, while we're on that, if by the end of February, early March, President Trump cracks a deal with China, is that going to be good for those Chinese stocks or bad?
I think it actually globally will be a sell the fact event. It's like travel and arrive, right? It's very similar. The market's been rallying because there's been lots and lots of hints about a deal being done. Yeah. When the deal's actually done, and it's probably going to be a handshake deal with not much substance, the market could actually sell the fact on that.
Do you think?
Oh, look, I just don't know. I think that the US Congress is so anti-China that this might go on for 10 or 20 years. This intellectual property theft game.
I can't invest for 10 or 20
years. No, you can. It's a bit of a sideshow, but it's a sentiment game. Does it mean the Chinese economy slows down a bit? Oh, a tiny bit. But the main point is it's higher input costs for American companies, tariffs and things like that. So, look, I don't think anyone wins out of this, but I am not investing on the basis of President Trump shaking President Xi's hand. I think that's ceremonial and meaningless and might actually lead to markets coming down a little bit.
Okay, some of the experts on this show and other places where I hang out in the money world think that we could retest the December lows. I think that's excessively negative, but what do you think?
I think that's excessively negative too. When the December market freefall crescendoed, the world thought the Federal Reserve was making a policy error. They were raising rates too quickly and they were shrinking their balance sheet too quickly, and liquidity conditions and financial conditions would get worsening dramatically, and most American companies are quite indebted, and the market voted with its feet in credit and equities to tell Jerome Powell that you're making a mistake. Since that point, obviously the Federal Reserve's done a monumental pivot, if you want to call it.
Discovered a great word called patience.
I think pivot's another word for backflip. We all do them. Yeah. But it's a backflip, a complete backflip, one of the biggest policy backflips you would ever see. Yeah. 6 weeks ago, they were full-scale rate rise.
It was basically December 19 or so where he backflipped and the market
bottomed on Christmas Eve.
Boom.
No, they bottomed on Christmas Eve. I remember that because they actually bought a couple of things.
December 24.
But for me, that limits the downside in markets. Since then, you've seen the Bank of England follow, the ECB follow, and even our own Reserve Bank's back at neutral or something. Yeah. Every central bank's backed off this whole concept of rate rises. So, for risk assets and equities, that probably underpins them at a level a bit above where they got to in December. But on the other side of things, GDP is being revised down around the world. Equity earnings are being revised down around the world in every sector and in every geography. So even this afternoon, as I was mentioning before the show, Morgan Stanley's chief market strategist, Michael Wilson, who's been absolutely excellent, downgraded his S&P 500 earnings growth for the year of 2019 to just 1%. So
and where was he before?
11% in November.
Okay.
So that's through time, the market is downgrading the earnings outlook for America at the index level. That doesn't mean you can't make money in American stocks.
But picking is going to be important.
Just the fact that the Federal Reserve and all these other central banks are backing off is because the world is slowing down a bit.
Yep.
But I really don't think that markets will retest the December low. I think that's too bearish.
Okay, you've made the point. Therefore, 2009 is going to be a stock picking year. Give us some local stocks and some overseas stocks that you think really look like good value at this point in time.
Well, it's interesting. You have to, think about your mindset. So what do low interest rates and low growth mean? That any stock that's got structural earnings growth, pricing power, and can grow its earnings and dividends faster at a multiple of the index, say in Australia that's 4% for the index, in America it's 1%, in Hong Kong it's probably 7%. That's the index growth.
Yeah.
So we're looking for things that have double-digit growth on reasonable PEs, strong balance sheets, and a bit of dividend growth.
So these are the filters that you...
Yeah, I think we always want to buy quality. You don't want to. You just don't want to end up in, low quality businesses.
Okay.
Not at this time of the the economic cycle.
Yep.
So in Australia, we're still strong on Aristocrat. We think that's got a good medium-term outlook. Reasonably priced, world leader in gaming machine software and social gaming. So we think that's looking quite good. As all the data that you can analyse says it's doing quite well. And it doesn't report this reporting season. It doesn't report till May. So there's no earnings risk there in the short term. But we really like Aristocrat. That's been a good one for us. Recovered quite nicely so far in January. Other stocks we like. Woodside, which reports this week. I think that's a reasonable...
So you must have a view on energy, do you?
No, I don't really. I have a view on LNG replacing oil through time, but I think the Australian liquefied natural gas exporters look cheap. Yeah. Santos, Woodside and Origin look like cheap stocks with reasonable growth and reasonable dividends to me. And I think Woodside should have a good result this Thursday. That's one we like.
It's also the better dividend payer.
Yeah, it pays about 5.5-ish, fully franked, has a good balance sheet and well-run company, good chairman, good CEO. I think that's an okay investment, Woodside. But we've also tried to take advantage of, like you and I have often discussed, Peter, the Australian market tends to horribly overreact both ways to everything. On the upside to good news, on the downside to bad news, particularly to bad news. Yeah. So we've added one stock in Australia that recently had a profit warning that we think might be a one-off profit warning, and that's the world leader in Respironics, which is ResMed. Stock fell 26%, got down to I think $13 odd. We started buying a few. The earnings downgrade was only 2 or 3%. The stock fell 23%, so it just had a huge PE wipeout. So ResMed's one out of favour one we've tried to add through this correction, and we will look for others that are out of favour where we think that the market's been too harsh versus what their earnings could be in the future. So there will be others this reporting season.
Okay, that's the local.
Yep.
Overseas, what do you like? I know you've talked to me in the past and you said, we're not a great fan of Apple anymore, are you? But there are some tech stocks in the US you still like.
Apple's still an okay investment, but it's it needs more than the iPhone. The iPhone still represents 63% of all revenues for that company. Services are about 15%. Services are higher margin, but they're growing. But they've really got to find something, a new product, a new something to help the iPhone's declining sales. There is no doubt in my mind, if you look at all the smartphone manufacturers around the world, including Samsung and the Chinese makers, we are at peak iPhone, peak smartphone. Everyone who wants one's got one. And now, so they need something else, whether it's services or a new product. So Apple we're not involved in, but we're not short them or anything. But I think that, what we're looking for is structural growth themes in America. And the two biggest holdings there are the Boeing Airline Company and Visa, which is a payments processing system that we all know. Yep. We all do the little tap and go at the cafe nowadays, and none of us really...
Are the Americans doing tap and go?
No, not so much. That's a great opportunity. They still use cheques and cash. Yeah. Really, they're way behind in terms of their adoption of digital payments and B2B payments. So I think Visa's going to be a good investment. They had a good result, earnings upgraded. Stocks, offers about 16% earnings growth. Huge company, 300 billion market cap. But I still think the star investment of this year in America will be the Boeing Airline Company. I think everything aligns very well for Boeing. They've got 20...
Do they sell aeroplanes to China?
Yes, and they also manufacture some airplanes in China, in China as well. Yeah. It's not a trade war play. It's a global aviation replacement cycle play.
And tourism to growth.
And it's also a defence play. People forget these people make F-18 Hornets and Apache helicopters, and the world's defence spending is going up as well. So Boeing for us is our biggest US investment. It's trading on about 20 times earnings, offers 24% EPS growth. It's a wonderful balance sheet, doing huge buybacks, really well run. And there's a classic company that's growing at 24%, we think, this year, maybe 30% of it. And the S&P 500 potentially offers 1%. So we think Boeing, even though it's up 25% so far this year, looks a good investment. If they pull back on any broader market pullback, I'll definitely be adding to both those names. Sure. But we're looking for other ones as well.
Charlie, thanks for joining us in the program.
Thank you, Peter.
That's Charlie Aiken, Aiken Investment Management, with his Inside information on the stocks he likes this year. Coming up, Julia Lee highlights the continuing positive and negative trends of reporting season and the stocks she likes as a consequence. Welcome back to Money Talks. I'm Peter Switzer. Now, each week, Bell Direct's Julia Lee gives us her stock of the week, and tonight she's going to use reporting season to pinpoint her favoured selection. Julia, good to see you.
Great to see you.
The stats around reporting season, they're really important, aren't they?
Absolutely, because they dictate the trends over the next 6 months. And just to give you an example from the August reporting season, I took the 3 best performing stocks in the ASX 200 and the 3 worst performing stocks.
Yeah.
Now, the 3 best, they included stocks like Appen, which was up by 41%, Altium, which was up by 35%, and Bravura, which was up by about 31%.
And they all reported well, you're saying?
They all reported well. For the month, they increased between 30 to 40%.
And bang, they've done well since then.
So from September till now, as a group, they've averaged about 8%. But the worst performing group, they lost 25 to 32%. And then after August till now, they've actually lost another 16%.
Oh, the trend has continued.
Absolutely.
Yeah.
And I think it demonstrates a lot of people are looking for bargains most of the time. However, in the period after reporting season, often it's those companies with those strong trends in terms of earnings that continue to outperform. And those ones.
What were those 3 companies? Were any of them quality companies or they...
Oh, the 3 worst ones.
Yeah.
So you had Speedcast, which looks at remote telecommunications. You also had Sims Group, which was impacted by lower margins, and Pact Group was down by 24%.
Yeah, probably Pact's probably the most quality performer amongst it all.
Out of the 3.
Okay, but they've got special problems there, I think, Pact. Now, let's go what you like as a consequence of what you're seeing in reporting season so far.
I liked Insurance Australia Group
last week, and you like it again since they've reported.
Yes, I still like them. And I guess if you have a
Rudy's
look...
going to probably text us and say, she's wrong again, but you were right and he was wrong.
But the reason I like it is because I believe that most things in life move in cycles and most stocks move in cycles. And when I'm looking at insurance companies, what I'm looking at is the insurance margin, and that tends to move up and down as well. And the great thing about Insurance Australia Group at the moment is that insurance margin is increasing. So 16 to 18%. Look, over the next 2 years, it'll probably peak, and that's the time.
It was down 44% last year.
It was. It's been under quite a bit of pressure. But I guess if you have a look at what's underpinning the move at the moment, as well as the optimism in terms of the stock, is not only the capital management that we saw last year, which was substantial. We saw 19.5 cents capital return, 5.5 cents special dividend. The interim dividend was 12 cents. But look, they are still looking at offloading parts of their Asian business. So that will free up probably another $1 billion in capital. And
okay, you made your point. AIG. All right, now, IAG. Now, what about some stocks that have reported already, like, for example, AV Jennings reported today? Do you have a view on that?
Yeah, well, we know the housing market is slowing down, so just being very careful of those companies that are coming out with softer earnings, especially if there is that skew to the second half. So I think AV Jennings said they meant to book some of that revenue in the first half, but they didn't manage to do it. So they are dependent on the second half, and if they don't book it, then you have the possibility of an earnings downgrade. So AV Jennings, and I guess the housing market, you know it's under pressure. We've heard from a number of different builders now talking about the pressures there.
Okay. Any other companies, like, for example, JB Hi-Fi? What was your reaction to their better-than-expected result?
You know, I would have expected a much bigger pop in terms of the share price, given that so much of the stock is short-sold. 15% of its stock is short-sold, and there's about 22 days of cover. And that means you probably didn't see a lot of short covering in the stock, which I think is amazing. So I think JB Hi-Fi is the best out of a bad group at the moment, and that is because of the domestic factors at the moment.
Any other stock you want to talk about as a consequence of reporting season so far?
Well, you know, I often get the question, why does a stock come out with a profit increase of 100, 200% and you know, yet its share price falls? The most important thing to remember about reporting season is about what's already priced in by the market and expected versus expectations. If the market was expecting to see 300% profit increase and you only saw a 100% profit increase, is the share price going to move up or down to adjust?
Yeah.
It's probably going to move down.
Yeah, well, I noticed today AVGening's profit was down 90%, but the share price at the time was only down 3 cents. Well, so the market was obviously anticipating all of it.
Well, they came out in December with that profit downgrade, so they delivered in line with expectations. The risk and the reason why it moved down further, I think, is the possibility of another downgrade coming through.
Julia, it seems to me that what you've done tonight is underline the value of coming on this program and for people to wait to hear what you have to say.
Thanks,
fantastic work. Julia Lee from Bell Direct. Now, coming up, Pengana's Stephen Glass joins us to share his best picks for OS stocks. Welcome back. Stephen Glass is Deputy Portfolio Manager of Pengana International Equity. So let's just see how he's positioning himself for the year ahead. Steve, thanks for joining us.
Thank you for having me.
Well, as I said to Charlie earlier in the program, a lot of my expert buddies think we're a chance of retesting a December lows. He didn't think that was the case. A pullback, he believed, but not as severe as the December lows. What do you think?
Well, you know, we're not into making market forecasts, particularly in the short term. I said that last time and I repeat it this time. But, you know, I'd say in 2019 we'll be doing exactly what we do in every other year, which is we have to go out and seek returns whilst having a lot of risk management around it. So when we're going to, this year, when we look for returns, we're actually looking in emerging markets. I don't think many people are looking in them right now, but the fact remains 85% of global growth is coming from emerging markets. They are growing, they are going to be bigger, the consumers are going to spend more. And those markets have been neglected by many people, so we're finding a lot of value in China and India.
Yeah. So emerging markets to you, primarily your focus will be China and India?
Well, yes, because they're the biggest, absolutely. But
and you're looking for the high-quality companies, I presume, in those?
Always. We always look for high-quality businesses. So some examples of companies we have in those countries are Bharti Infratel in India, which is the largest mobile tower business in India. They're
kind of usul for a mobile
They're kind of useful. They're pretty useful things. So there's less than 500,000 mobile phone towers in India. There's about 2 million in China. I'm pretty sure I know where that 500 million is going to go. And this company is the market share leader. It has a rock-solid balance sheet, and its valuation is half of its peers in other markets. So we think it looks very interesting. In China, we're looking at companies like Wazoo Group, which is a very fast-growing hotel brand there, run by a fantastic entrepreneur who's doing amazing things. So yes, we look for market leaders at good valuations in these growing markets.
Is tourism on the rise in China, both from external tourists and intra?
It's absolutely on the rise. It's not just tourism, it's also business travel, but it's growing at rates that I think would make most Australian tourist businesses blush. So it's growing very rapidly, and these things are reasonable value. Now, having said that, we're not going to put all our eggs into the emerging market basket. We've also got a lot of risk management or more defensive positions in our portfolio. So we think the derivative exchanges are very interesting, because derivative exchanges like CME, Deutsche Börse and Intercontinental Exchange actually make more money during volatile periods. So we've got our ballast.
Are they vulnerable to a serious stock market crash, the derivative
They make more money.
They make more money?
They're actually not stock exchanges, they're derivative exchanges. And so what happens when there's uncertainty and volatility, people want to buy insurance to protect themselves. And these people are the arms dealers of that insurance. So they always win.
With a single inverted commas, the arms dealers.
Exactly. So they are natural monopolies. They've got fantastic underlying growth drivers. And we saw in the market pullback in the last quarter, they actually did very well.
Okay, so what's in the stable of those derivative exchanges?
Well, CME, which is the largest one, it is the leader in probably all derivatives except for European derivatives. So particularly US interest rate derivatives, it's very strong in. Commodity derivatives, it's very strong in. Agricultural derivatives, it's strong in. It's strong across the board. And it really is a fantastic business. Now, all of these things don't necessarily come optically cheap. It's on a 24 times PE, and that would scare off many value managers. However, the fact of the matter is 24 times is not bad if you consider these companies can grow at exponential rates just when you want them to. So when things are very, very tough.
And you call these defensive plays.
Absolutely.
Now explain, because most people these seem so speculative, but explain why you see them as being defensive.
Well, first of all, they have very, very strong competitive positions. They're natural monopolies. They benefit from...
Big moats.
Huge moats. They benefit from network effects. And what that means, if you're going to sell a derivative, you want to go where all the buyers are. If you want to buy a derivative, you want to go where all the sellers are. And so all the volume aggregates in one place. And that one place is CME for the vast majority of derivatives, ICE, Intercontinental Exchange, for Brent oil derivatives, and Deutsche Börse for European interest rates derivatives. These are big companies, multi-billion-dollar companies.
Okay, and you're exposed to all three companies?
We've got a large exposure to them.
How many stocks do you have in your fund, Steve?
We have 40 stocks, so we think you always want to be diversified. It can be very in vogue to say we're going to have a very concentrated portfolio, and you can momentarily have fantastic returns with those ultra-concentrated portfolios, but we think it's risky. Having said that, you don't want to be too diversified because then you become an ETF. So we think the sweet spot is between 30 and 50 stocks, and we currently have 40.
And what is the most garden variety type company that you're holding? Because every one of these, all my viewers would say, hell, I've never thought about investing in those companies. What is you must have some foundation companies that you always go back to?
Well, it's a great question because we actually divide our portfolio into three parts: core, cyclical and opportunistic, and that gives us exposure to all market segments. Now, core are those garden variety stocks. You might not have heard of them, but they're big dominant businesses that are market leaders. 60 to 70% of our fund is in them, and that includes Coca-Cola, Nestle.
I think some people have heard of those companies.
Coca-Cola and Nestle. But CME, look, many of your viewers might not have heard of CME, but I can tell you every person in the financial markets has.
I think on this channel CME has bobbed up occasionally.
I'm sure it has. We have Cigna, which is a dominant health insurer. There's a lot of business. We don't invest in microcaps. These are all large dominant businesses. But if I was to say a few names you've heard of, Heineken, Coca-Cola and Nestle.
And so do you have a view that because you like the companies, when markets do become stupid and sell off ridiculously, do you tend to accumulate those?
We like to buy them when the market sells off. Look, just because something drops doesn't make it cheap. No. But in the stocks that we hold, we think if they drop, they're a good buy, and particularly if they're in core. Those are the stocks you want to own more of if they drop.
Okay, Steve, thanks for joining us.
Thank you very much.
Stephen Glass from Pengana. Obviously a very interesting approach to investment. So thanks for joining us on the program. If you want to see what I'm thinking about in terms of my market playing thoughts each morning, you can go to switzer.com.au. That's it for Money Talks. I'll see you next week. I'm Peter Switzer.